I think you'll see the CPI moving towards 10% within the next couple of months. And as that accelerates, you look at circumstances where people did have the hyperinflation. It tends to come on very quickly. And in that type of circumstance, with strong inflation, the best bet you have to preserve the purchasing power of your assets. And again, I'm looking at inflation here in the U.S. dollar, is holding physical gold and silver.
Welcome to the Gold Republic podcast. My name is Bart Brands.
And I'm Alexei Jordanov. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments. Is there a chance that just during when we start dropping again in, for example, GDP growth, that's the moment where the Fed starts to taper and immediately causes a new recession or depression, and then they will have to start the printing presses again? Is that a right assumption to make if I follow your analysis?
No, I think you've misread me there. I think what we're getting with this tapering talk is basically jawboning for the financial markets and say, oh yeah, we're doing everything. We're going to keep things under control here. We're going to keep the money supply contained. And so instead of tapering in 2 years, or 3 years, which had been the initial forecast, and then they maybe moved it at a quarter, 2 years out. Now they put out, okay, now we're going to have tapering possibly by the end of this year. And so the idea there is, well, it'll tend to dampen the inflationary expectations because they know we're going to pull back. What I'm saying is they know they can't pull back. And again, it's not inflation, it's not the economy, it's the banking system. And as this pulls back, the banks are in trouble. And they're going to do whatever they have to support the banks. That's their primary function. And in terms of where this comes in to actually take us into a hyperinflation, you'll have people talk about how the money supply can drive inflation, and very particularly the velocity of money. That's the speed at which the amount of money in the money supply divided into the amount of money into the economy, the speed in which the money supply turns over in the economy. The concept is the higher that is, the greater the inflation is going to be. And that's true, but that's also with a strong economy. You get that type of money supply turnover, you have a strong economy, and with a strong economy, you generally will have some inflation. What we have is the complete opposite circumstance right now. The economy is depressed, money supply is explosive. You have a very low velocity of money. And that's a circumstance that you get with the hyperinflation, such as you saw with the Weimar Republic, Zimbabwe, Venezuela. That's where we're beginning to see inflation here now, which is not being driven by strong economic demand. I mean, there's some element of that where you have shortages of things, but it's not real strong demand. It's more shortages, and the money. There's too much money going around for too few goods, and they're being bid up. That's where we're beginning to get into this what could become a hyperinflation. And in that type of circumstance, with strong inflation, the best bet you have to preserve the purchasing power of your assets. And again, I'm looking at inflation here in the U.S. dollar, is holding physical gold and silver.
You're on the right podcast for those kind of claims, of course. We're at the Gold Republic podcast, so we see it the same way. And one of the key I think questions here is also to try to figure out what the root cause of this inflation is. You've said hyperinflation, so to many it sounds like something that is only read in the history books or in other countries beyond, let's say, the Western countries. And there are different causes in the ways we can maybe explain it as cost push and demand pull type of inflation. And it seems that just like you alluded to it, that's what we ask ourselves. Is it maybe a mix of those? Is it maybe because a cost push is in the supply chains? We see the rising cost of wages, for example, in the whole restaurants or looking for waiters or all that, basically everything which has to do with hotels or leisure. There's been big demands for labor after the reopening, which seemed to be temporary. But now we've seen, for example, truck drivers in the UK. They look for 150,000 truck drivers in the UK. And that's, one could say, is due to Brexit and so on. But we've seen a lot of those forces, and some are basically related to labor. But also then on the other side, we will look at oil prices start to rise as well. And then we have the demand pull of the reopening, where people started to basically wants to consume and make more expenditures. So how does what I just said make sense, if it even makes sense, and what would be your analysis on that?
Well, I think it does make sense, and you have both factors at work. It is it's the money's out there, so people, if they want things, they can buy it, and there's an inadequate supply. It tends to push the prices up. I have you've seen that in automobiles, for example, used automobiles. Now the new automobiles are having problems as well, because there's a shortage of being able to produce them. There's a chip shortage. So you have bidding issues. Companies will raise their prices in order to dampen the demand a little bit, make more money. Dampen the demand because they can't supply all the demand. It is for the average person. Unless you control your own company and you can raise your prices along with what's happening. I mean, I know I have clients who are middlemen, or they're in the wholesale trade, or they sell raw materials. They sell certain products into the production cycle, and I talk with them fairly regularly, and I got an initial heads up. Gee, my cost of these chemicals are up 60%, and I just have to pass that along, and people are accepting it. They're not griping about it. So that's going through the supply chain, and that's going to push things higher. That's the direct cost at. I talked with them recently. See, has there been any abatement there? Things. He says no, still way up. And where you have the shortages, it's going to eventually get worked around, but sort of a perfect storm for economic disaster that hit with this COVID crisis. The U.S. just shut down its economy, but it was not an orderly shutdown. Labor got misallocated. Some businesses stayed in business, others didn't. Products didn't get made. People are not coming back to work, or they don't want to get exposed to. Again, the system's not in balance, and so you have the shortages. You have some production that's going out there, but again, there's an awful lot of cash floating around, and the Fed's going to keep pumping it in. And you start to see that we're going to have inflation numbers picking up this next month or two. I think you'll see the CPI moving towards 10% within the next couple of months. And as that accelerates, you look at circumstances where people did have the hyperinflation. It tends to come on very quickly. I mean, it's had some bad inflation, but when it goes hyper, it moves terribly. I knew some people in Germany who had lived through the Weimar Republic, or had with their parents or their kids at the time, and the story generally was that it came very sudden, and all of a sudden the store shelves were empty. And one story of how one guy's father traded a can of beans, or traded a shirt for a can of beans for dinner. Took it home for the family, and they opened the can of beans. The beans had gone bad. So even there, you don't necessarily have a perfect store of wealth, but it's not a bad idea to have a store of necessities like canned goods in this type of circumstance too, because as the prices skyrocket, but people get scared. They're gonna stock up on stuff, and you're not going to see it on the store shelves. But before it got out of control, there was a period where you could go to a fancy restaurant, and you'd sit down to order your dinner, but you'd negotiate the price of the food before dinner because it would cost you more after dinner. Or you'd have, let's say, a nice bottle of wine that night. The next morning, that empty glass bottle was worth more as scrap glass than it had been worth the night before, filled with fine wine. I mean, that's how rapidly as you're going into the hyper end of it. It's frightening. It can come quickly, but if you start to see things getting up over 10%.
Some serious words, John. I just wanted to ask you, because of course your time is precious and limited in contradiction to the dollars that are printed into oblivion. John, have you ever seen, because you have been measuring inflation, tracking inflation for a long time, have you ever seen something like what's happening now? Because as you're speaking, I really have the feeling that you feel that something really serious is afoot.
You're correct. I can't think of anything quite like this that has happened before in the United States. Again, it's extraordinary economic turmoil, displacement, combined with the unfettered money creation, and of course the fiscal stimulus by the federal government. Now, all that they had to do that. I mean, it was. I'm not saying they shouldn't have done it. I'm just saying that there's a cost to it, and I think their option was, well, better to risk inflation than have a Great Depression. And effectively, what we saw initially was a Great Depression. The numbers that came out with the layoffs and such are worse than anything seen since the Great Depression. And in fact, there's still some measures that have parallels with that time frame. So the stimulus checks, the money supply creation, that's helped. It's helped to stabilize the system some, stabilize the populace some, but the inflation is the thing that will become the big destabilizer as you go down the road. And if they can't bring that under control, it's going to be head for the hills time in at least here in the United States. Good time to own gold and silver.
In that perspective, so hyperinflation is considered because we have different stages of inflation, right? There's creeping inflation, then runaway inflation, and then hyperinflation. As of when can it be called hyperinflation?
Well, the worst case that I'm aware of is Zimbabwe. And the finance minister there just said that he'd follow the policies of the Federal Reserve and start creating money. And then he started making more money. They had a $2 bill. I'm sure you've seen these. They end up the final denomination, I think, was $100 trillion bill, the equivalent of the $2 bill. And that took place over some years. What was unusual with Zimbabwe and what enabled them to have that hyperinflation was that they had a backup of the US dollar. The US dollar was to them like gold. Because if you were paid in the Zimbabwe dollar and you knew it was going to be worth at 1% of what it was when you got it that evening, you went to the black market and you exchanged it for US dollars. And you held the US dollars the way some people now have always held gold and silver, but it was a store of wealth for them. And because of that, they were able to mitigate the issues. We don't have a U.S. dollar that we can go to as it starts to hyperinflate. The store of wealth here is against the precious metals. That's as I see it. So that it's probably slower than it came on in Zimbabwe, but it gets so bad so fast it doesn't make much difference. I mean, if you have $100 today, and it's worth $1 tomorrow and a penny the next day, how much further it goes. If the United States had the hyperinflation that Zimbabwe had, it could pay off all its debts for less than a penny. The point is, you can get to a very bad hyperinflation, a place where you have people trading cans, shirts for cans within a year. I mean, it shouldn't take longer than that if they keep going the way they're going.
Why do policymakers or politicians always think that hyperinflation will not happen to them?
Wishful thinking. You listen to the Fed as they started pumping this money. Oh, don't worry, we're going to get up to maybe 3% inflation, and that's what we want to get it above 3% and hold it up there for a little bit. And then all of a sudden we're up at 5%, and they say, well, it's temporary as we thought it's going to be. They knew what they were doing. You don't talk about it up front. Say, we're going to do this and have a hyperinflation, because then people will start behaving as though there's going to be hyperinflation, and it becomes something of a self-fulfilling prophecy. As people begin to recognize that there's a real problem here, that's the self-fulfilling prophecy becomes a real problem too.
So this is also the point where your data comes in, because there's official reported data from, let's say, the Fed in that case. And then there's also your models that you've been also publishing on ShadowStats.com, and for which a lot of people also know ShadowStats, is because you're able to give a maybe more accurate sense of inflation. What are your now predictions and models at this point in terms of inflation for the year to come?
My numbers are based on the CPI and reporting gimmicks that they changed, things that would tend to lower the headline number. It is, so what I have is largely based on the CPI, and the inflation that you'll see with the CPI, you'll see with mine as well. In fact, the difference between my number and the government's number will become relatively less as it gets out of control. I mean, it's not going to be that the federal government's numbers are going to be 1,000% and I'm going to be 2,000%. I'll probably be 1,020% or something like that. The hyperinflation is a hyperinflation, and it doesn't matter. Once you get into it, the currency that you're basing it on becomes worthless, and then it's a matter of how you come out of that. Mm-hmm. Again, whether it drops, the value drops to a penny or a hundredth of a penny from $1,000 doesn't make any difference.
we could see that gold, as you said, is in a way a hedge or follows the price very closely of just in general the inflation, and it correlates. But lately, as inflation increased, the price of gold depreciated from its top. How would you see that difference, if it's just like something temporary, or you see it more on a long-term basis?
That's temporary, and that's gimmicked. What can I tell you? You have vested interest in the financial markets that gold not soar and draw in all the dollars that otherwise might go into the stock market or other areas. It's not a gold will catch up, and it's again as the inflation picks up, there's no it will come into line. Of that I am confident. I mean, they can always intervene, sell gold, and knock it down, but you've got an environment here that's not going to be particularly good for equities. I know the stock market's booming ahead, and at all-time highs in the United States, but nothing like what you'll see with the precious metals as the inflation gets better.
So gold and silver is the only assets for hyperinflation that you think is safe?
And physical. And in fact, I would tend to go with coins that are minted by a recognized mint, so that if you end up in a barter situation, people look at that and they say, accept it. They won't say, well, gee, I want to assay that, because it's a gold bar or something like that. In fact, having both gold and silver is a good idea. And in fact, I'd look to have in the United States, what we have is in the way of bags of silver coins, old quarters and dimes, because as the hyperinflation kicks in, I mean, that quarter may buy you $100 worth of groceries, and where an equivalent amount of gold would be overkill. You wouldn't be able to maybe buy a house. Real estate should tend to preserve its value over time. That's why it's got the term real in it. The only problem is that you can have some big price fluctuations over time. Again, it'll hold its value, but if you have social upheaval, which is always a risk with difficult times like this, it's not portable. So also inflation's the debtor's friend. If you owe someone $1,000 or 1,000 pounds, and you don't have to, it's not inflation adjusted. You get a high rate of inflation here, you can pay it off for an old penny. I mean, that's as the U.S. could with its debt.
Well, John, thank you, of course, for being our guest. To all the viewers to the Gold Republic podcast, John has his own website. It's called ShadowStats.com. Feel free, of course, to visit his website. John, would you like to say something about ShadowStats.com and what you offer your clients there?
Sure. On my website, right-hand column, it's called a daily update. I have to update that as soon as new numbers come out. You have to scroll down. It's about 9 pages long if you were to print it out. But you just scroll down and it gives you an update on whatever's happening in the news and any changes that I've seen with inflation or the money supply. That's available to anyone. I also have a subscription newsletter called ShadowStats. It is in fact, I'm putting out a big catch-up issue. I've been with this. Everything's covered on the homepage, but I've got a big catch-up issue coming up this week. It's available. It's provided by email to you, so you can view it electronically. It runs $175 a year. Got a 6-month subscription for $89, and everything that's been printed is available there. Go back, for 3 months. All the newsletters are open to you. whether or not you're a subscriber.
All right.
So you can see
Thank you. Well, John, thank you very much. Well, if you've enjoyed this podcast, of course, feel free to give it a like. If you haven't subscribed to the YouTube channel, feel free to subscribe. If you have any questions, feel free to leave them in the comment section. Alexei?
Yeah, and if you've listened to the podcast on any kind of a podcast platform, you can also give it a rating. It helps us to be more visible. And you can also forward this episode to anyone who you think it might be interesting to.
John, thank you very much. And we will see each other at the new episode of the Gold Republic podcast.